Welcome, everyone, to the Planet MicroCap Showcase Vancouver 2023. I'm your host, Robert Kraft, and I'm really excited to share with you one of our virtual keynotes for our event here today. And doing this keynote titled How to Raise Capital in the US is Lynne Bolduc. Lynne is a partner at Fitzgerald Creditor Bolduc Riseborough LLP with offices in Los Angeles and Orange County, California. Lynne got her start in the financing world over 30 years ago as in-house legal and compliance at investment banks, where she learned from the inside what bankers and investors want to see in a company and how to structure deals that sell. Lynne now runs her law firm's corporate and securities department, where she specializes in making financing transactions as simple as possible. She represents startups through public companies in all stages of their growth and development, including private placements, IPOs, and follow-on public offerings, and SEC reporting. Lynne also acts as an expert witness in corporate and securities cases and sits on the boards of directors of private and public companies. She is here today to share with us the various options available for raising money, both privately and publicly in the US. And with that, Lynne, take it away.
Hello. Thank you for the nice introduction, Bobby. As we move through the slides, I'm not going to read what's on the slides. I'm going to discuss the upsides and downsides of the various options. I'm happy to share my slides with you, and my contact information is in your conference material. With that, let's launch in to how to raise money in the US. There are two types of offerings, private and public. I'm going to discuss both, but just so you know, public offering requires a company to file their offering documents with the Securities and Exchange Commission and go through a review and comment process until the SEC is satisfied with the disclosure in your documents. And only once the SEC says they have no further comments can you raise any money on that offering. A private offering does not require advanced review by the SEC. Now, the choice of an offering generally comes down to two determining factors. Number one, whether the company needs to advertise in order to raise money, and investor suitability. Just so you know, advertising, when I talk about that throughout the presentation, it's the traditional advertising such as in industry publications, magazines, radio, and television, as well as on the internet and social media. The concept of advertising also includes general solicitation. General solicitation means contacting people with whom the principals of the company do not have a pre-existing substantive relationship prior to the offering. A lot of people think that they're not going to advertise, but they can get referred to investors. They can reach out to people they may not know over the phone or the email, and you can't. So when I talk about advertising throughout the presentation, it includes general solicitation. The other key definition to note as we move through the options is investor suitability. That generally means accredited investors or non-accredited investors. An accredited investor is an individual who has a net worth of $1 million, excluding their primary residence, or $200,000 in annual income alone, or $300,000 in annual income jointly with their spouse over the last 2 years, with the reasonable expectation of the same in the current year. So now that we have the definitions down, we're going to start with the exemptions. Private offerings are exempt from registration with the Securities and Exchange Commission. Most companies start off doing a private offering, not a public offering. Most companies start off doing a 504 offering. This is commonly known as a friends and family offering. You may have heard that term. In a friends and family offering, you can raise up to $10 million every 12 months, and that's a lot. This offering started off at $1 million, then they raised it to $5 million, and now you can raise $10 million every year. Upside to the friends and family offering, you can raise that $10 million from an unlimited number of accredited investors and non-accredited investors. That is key for getting started with a new company, startup, development stage company. Another upside is there's no specific requirements for disclosure. You should use an agreement and you should give the investors a business plan, executive summary, financial statements, whatever you have. But there's nothing specified other than disclosing everything material about the company in the offering. Downside to the friends and family. Advertising and general solicitation are not allowed. That's why it's called friends and family. You can only contact your friends and your family. Another downside to the friends and family offering is that it is not exempt from registration with the states in the US, meaning you have to actually look up the states of residence of every investor and find an exemption specifically. The next private offerings that we'll talk about, they're exempt from federal and state. 504 friends and family is only exempt from federal. Luckily, there are a lot of exemptions in the states that you can find where you don't have to make a filing. So it's just kind of a hassle factor. The next private offering used to be the standard private offering exemption and the one most commonly used. It's known as 506B. Under 506B, you can raise an unlimited amount of money from an unlimited number of accredited and up to 35 non-accredited investors. A disclosure document is required. It usually takes the form of a private placement memorandum. If the offering is made to accredited investors only, there's no specific requirements for that PPM. You'll want to put in there a bunch of risk factors, a description of your business, financials, your plans, etc. But it's nothing specific. If you want to take advantage of the 35 non-accredited investor allowance, you have to follow some specific rules. And it's very specific and precise, and your PPM looks more like a prospectus for a public company. But then again, you do get the 35 non-accredited investors. Like the friends and family, advertising and general solicitation are not allowed in a 506B. An upside is that the investors only need to check a box representing that they are accredited. So you'll have a subscription agreement and they'll check the box and say, I have the net worth or the income requirement. They don't read to verify any of their information or their status or what they say is true. 506B offerings are exempt from both federal and state regulation. 15 calendar days after the date of the first sale, you have to make a filing with the U.S. Securities and Exchange Commission and the states of residence of each investor. You don't need to make the filing till after you get an investor. You only need to make the filings once per state. And there's no review of your documents or comment process. It's a notice filing only. So it's relatively simple. Now we're moving on to a sea change. In 2013, President Obama proposed legislation to Congress called the Jobs Act. It stands for Jumpstart Our Business Startups. Fun fact, this was one of the rare pieces of legislation that was approved unanimously by everyone in Congress. All the Democrats, all the Republicans, everyone voted to approve the Jobs Act. It helps small businesses to raise money. So we have now 506C. And under Rule 506C, you're allowed to raise an unlimited amount of money from an unlimited number of accredited investors, no non-accredited investors whatsoever. It's one of the downsides. You need a PPM. But the great thing about it is unlimited advertising and general solicitation are allowed. You can put your PPM on your website. You can put it on third-party platforms. You can give presentations. You can host dinners. I could refer somebody to you and say, oh, hey, Bobby might be interested in investing in your offering, and you could contact him and he could invest. You do not need to have that pre-existing substantive relationship with the investors. What's the catch for all this freedom? The catch is the investors not only need to check off a box on the subscription agreement stating that they're accredited, they need to prove they are accredited. It's called verification. And that verification can be done in one of two ways. They can have a licensed professional, such as a tax preparer, a CPA, a financial planner, a lawyer, a broker, sign a little form that says, yes, I know Lynn, I'm her broker. She has the net worth that she says she has. If the investor doesn't want to have a third-party verification, the investor can provide a document that proves that what they say is true. The document can be anything. It can be a bank statement, it can be W-2s, it can be a brokerage account statement. They have to verify their status. That's sort of the catch that you have to do in order to have the advertising. That, and there's no non-accredited investors allowed. Same as with 506B, it is exempt from federal and state regulation. This is fast becoming the most popular way to conduct a private offering in the US. Even if you don't plan on advertising, it's sort of an insurance policy because you could never be accused of a general solicitation. I'm not going to spend a lot of time talking about California, given our audience. Just know that there is an allowance in the state of California for a California company made to California investors only, up to $5 million, lower suitability standards, and limited advertising. Now we're going to move on to public offerings. Remember, public offerings, all of these offerings require SEC approval before you can raise money using them. The first one you've probably heard of, regulation crowdfunding, also known as crowdfunding or Reg CF. This came about because of the Jobs Act as well. And this public offering is very rarely used. And here's why. You can raise up to $5 million every 12 months. As you can see, that's lower than even the friends and family offering. You can raise the money from an unlimited number of accredited and non-accredited investors. There's limits on how much non-accredited investors can invest. However, in addition to filing the document with the SEC and requiring their approval before you can sell any securities, financial statements are required. And depending on how much money you want to raise, the financial statements can either be internal, reviewed by an accounting firm, or sometimes they have to be audited by the accounting firm. So that's a high bar for a startup company. After you qualify your Reg CF, your crowdfunding offering, you have to file an annual report with the SEC and provide it to investors every year. And last, the advertising is not unlimited like it is with the 506C private offering. You're only allowed to do a tombstone advertising. A tombstone is basically one page that says the company's name and address, a brief description of the business, the offering terms, and where to get the full disclosure document on the SEC's website. So the advertising is not unlimited. So you can see why now that this regulation crowdfunding is not very popular. Moving on to Regulation A. We've had Regulation A for many years, however, it got expanded pursuant to the Jobs Act in 2013. So Reg A plus, they call it now, has two tiers. Under Tier 1, you can raise 20 million. Under Tier 2, you can raise 75 million. You can raise this money from an unlimited number of accredited and non-accredited investors. That's an upside. You have to get SEC approval on your document first. Unlimited advertising and general solicitation are allowed. Also, a key feature of a Regulation A offering is you can test the waters while your document is being reviewed and you're going through the comment process with the SEC. You can take indications of interest. You can't take any money in, but you can test the waters and get people interested in your offering as you wait for the SEC to approve it. The difference between the Tier 1 and the Tier 2 is that Tier 1 does not require financial statements. Well, that doesn't require audited financial statements. Tier 2 requires audited financial statements. Tier 1 requires you to qualify your offering with the states, not just a notice filing like we talked about before, the blue sky notice filing after you make a sale in the state. You have to get permission from the states prior to making a sale in the state. So that's a big hassle factor. So most companies use the Tier 2 allowance and they have audited financial statements, unlimited advertising, and they don't need to do any of the blue sky filings. About 80%, 85% of the Reg A offerings are now Tier 2, not Tier 1. Reg A is becoming a little bit more popular these days because the markets here in the US have been a little bit challenging, and the underwriter is having a difficult time raising, a lot of money in an IPO for, certain new companies. So a lot of companies are now taking a two-step process, and they're doing a Reg A offering and then doing an uplist to an exchange. In a Reg A offering, your securities can trade on an over-the-counter market. They cannot trade on a stock exchange like NASDAQ or NYSE, but they can trade on the over-the-counter market. You can raise some money. You have a lower reporting requirement than a traditional IPO. It's higher than the Reg CF. You have to file an annual, a semi-annual, and current reports when material changes happen in your offering. But it can be a good way to go if you can't go directly to a big IPO, which is where we're going to go now. A traditional IPO is also known as regular way. A traditional IPO has an underwriter. The underwriter raises the money for you. They do the offering and selling of the securities. You can raise an unlimited amount of money, unlimited advertising, accredited and non-accredited investors. Downsides, it's a lengthy and expensive process. It could take a long time to get your audited financial statements together. And not only do you have to get SEC review and approval, you have to have the review and approval of the stock exchange, whichever one you choose, NASDAQ or the New York Stock Exchange, Big Board, or New York Stock Exchange American. As an example, in 2018, I was retained by a company. They were private. They had a firm commitment letter of intent from a Wall Street underwriter for a $15 million IPO. We did that $15 million IPO in 2020. It took them almost 2 years to get that done. So that's the downside. They always say, if you want to go public, the process started yesterday, not tomorrow. It takes time, but you are public after that, and you have a lot of money, and you also have a runway to raise more money as a public company. As a public company, you have to file all of the reports required for public companies. So you may have also heard of a direct listing. A direct listing is the same as a regular way IPO, but there's no underwriter. In a direct listing, the company goes public itself. It's very challenging. You don't see a lot of them, but some companies can qualify for the stock exchange. They already meet the requirements, and they just want to register their shares and list on the exchange. You've probably heard of SPACs before. They're somewhat out of favor right now. Special purpose acquisition companies. It's the same as a regular way IPO, but it's a shell company formed for a specific purpose. Once they raise the money, they go out and acquire other companies and businesses and pursue their business plans. Okay, I'll leave you with a fun fact. The first IPO was in the Netherlands. The first Ponzi scheme was also in the Netherlands. It involved tulip bulbs. You'll see Q&A there on my slide, and obviously we're not going to have Q&A because this was being recorded, and we can have Q&A when you contact me by phone or email. So thanks for listening.
And Lynn, thank you so much for your presentation here today.
Thank you for having me. Enjoy the conference.